Hello and a warm welcome to Portfolio Watch. I'm Gugulethu Mfuphi. Now, in today's episode, we take a look at the influence of cycles on commodity markets and, of course, the investment case that this presents for mining companies globally. My guests in studio this evening are Andrew Dittberner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Govender, Portfolio Manager at Swiss Offshore specifically. Gentlemen, great to have you with us today, and thanks for making time. I think as we're discussing this off air, when we talk about commodities as well as mining companies, I recall not too long ago when everyone was saying, the cycle's not in the right frame at the moment, and of course it's not maybe one of those sexy sectors that one should be investing in. But goodness, how macroeconomic conditions, political changes, and of course currency influences can manage to change things, right, Andrew?
Absolutely. I think you capture it when you say it's not a sexy industry. It's not sexy by any stretch of the imagination. But talking about cycles as well, I mean, if you just think, go back to the 2000s and we saw that commodity boom and, what these companies did, and everyone loved commodities specifically, or mining houses specifically here in South Africa. Then global financial crisis comes along and we know what happened to commodity prices. And then 2014, 2015, a lot of the global diversified companies that are listed in South Africa, had material issues with their balance sheets. And you remember the likes of Glencore, I think it went down to about 15 Rand a share. Today it's at 60 odd Rand. Anglo-American, and everyone hated commodities, and it was the worst place to be. And now today, when you look back over year to date, I think commodities are up about 20%. The market's down, I think, close to 10%.
Yeah.
And take that back 2 years or even 3 years, commodity companies or resources have done really, really well. So they seem to be back in vogue, despite when you think about what's going on in the macro environment at the moment. There's a lot of negative sentiment, when you think of synchronized global growth, maybe falling, well, not falling apart, but, be dismantling slightly, trade tensions, geopolitical tensions in the Middle East. So there's a lot going on at the moment.
Quite a lot going on at the moment, and of course that does influence the dynamics. We did see with Donald Trump, when he was elected, this huge drive for infrastructure development, and that saw quite a lot of optimism, not only in mining stocks, but this overall view that there will be continued growth in many of these markets. Is that still there? Has that changed slightly? And is the pressure appearing in emerging markets also adding to the dynamics that we see in these commodity players?
So I think it's the Trump trade that you referred to. I think his very first speech when he was elected, he spoke about rebuilding America, and he's going to build ports and railways and roads and this big wall on the northern border of Mexico. And any company that was related to, materials, infrastructure, mining, building, went through the roof, and that became known as the Trump trade. When reality set in, after a couple of months, that all kind of unwound. But commodity prices still remain, very dependent on global growth, emerging markets in particular, China specifically. And the structural slowdown that we've seen in China is, has weighed, particularly on your base metals, and you've seen it coming through in your copper prices, iron ore prices, etc.
I'd like to come to you here for a moment, Viv, to get your thoughts on what we've seen, given that this is a very cyclical sector. I do know that a lot of senior citizens, I think baby boomers and Gen Xers actually love a lot of mining companies. There was a time when Anglos was the darling of the JSE. But how should we as investors be reacting to these changing dynamics and understanding that commodities, even though they display a lot of cyclicality, but still can form a good basis in one's investment portfolio? I
think some baby boomers can remember when Anglos was the JSE effectively.
Exactly.
Look, I think we, to a certain extent, have lived through a part of history that is almost going to be unrepeatable. I mean, we saw China effectively emerge from being a third world country to being on the way to being, a middle income or in the future maybe even a first world country. That scenario where you take about 1 in 5+% or 1 in 5 of the world's population effectively, and basically take them from being effectively starving in the late 1950s to where they are today, is something that does not occur every decade or every couple decades or every lifetime even. And the other growth opportunities I see for the commodity sector on that large, we talk about the 50,000 mile view, we're looking from a very high point of view, is that there is very little chance you can see that kind of growth in terms of infrastructure build in places like India or in Africa, which is the other two options for growth in terms of infrastructure like China has had over the last couple of decades. The reason being is those Africa is too fragmented. It's very difficult to get these mega projects on the go. India as well has a lot of political, democracy is great for stability, also great for not doing anything. And that's what India can't do, can't build the kind of stuff that China builds, where they move 3 million people to build a dam. India can't move 400 people to build a factory, literally. So I'm looking at the kind of macro demand picture. China is not there yet, but it's probably going to come there in the next decade or so. We've seen that in places like Taiwan, in Japan, in any of the East Asian countries, where you get to a point where you actually have less per capita, or less per unit GDP consumption of resources, because you're becoming higher up the food chain. You produce more services, you don't produce as much, bulky, resource-intensive goods. And you're seeing that happening in China at the moment. Their high-tech, medium-tech exports have risen dramatically compared to where they were like a decade ago, even we're talking more than doubling in some of the categories.
Sure.
So these things are going to change what China is going to need coming in. Look, right now there's talks about ghost cities in China. That stuff I think is old news. But it does seem to indicate that that's changing in one way. The other way it's changing is that as China has gotten richer, they are getting more insensitive to the environment, which actually help companies like Kumba and so on, because what happens is that they don't want to have just any form of iron ore coming in. They need to have the higher grade stuff so they don't pollute as much in their environment, which has actually helped us. I mean, that was a surprise. When I was looking at the forecast for iron ore that I had a couple of years ago, I thought, with the supply coming to the market, it'll be like a bit more of a bloodbath in the iron ore sector, but it didn't turn out not to be, because what happened was China was becoming more and more environmentally conscious, and therefore was only looking at more and more high grade iron ore, which is not found in their local mines.
It's interesting that you mention that, because it does speak to this changing view that we have on how we actually use these metals, right? Also, given that we're approaching the fourth industrial revolution, artificial intelligence, as well as a strive for disruptive and innovation in the technology space, this obviously calls for a different kind of demand regarding the commodities that we look to use. How do we see this playing out, and how does it also impact on the market prices? And are we seeing that mining companies are being more nimble and agile enough to adapt to these changing dynamics?
Yeah, I think there obviously is an element of, if you look at electric vehicles, for instance, now here's going to be a demand for zinc, cobalt, nickel, copper in particular. So there might be, that sort of shift in demand slightly. But, when you think of the global population, Viv touched on it, and whilst China has seen this huge growth, through, particularly, from the late 90s through to today, and becoming the second biggest economy and soon to be the biggest economy in probably the next decade or so, it's still a poor economy. When you look at it from a GDP per capita point of view, they've still got a very, very long way to go until they get to, where the likes of your developed world sit. So I think there's still very long runway from, infrastructure build spend, not just in China, but emerging markets across the world. So I don't think, the demand for your industrial metals, base metals, iron ore, coal, etc., are going to fall off a cliff. But there is definitely more demand, and we've seen it from some of the companies. The likes of Billiton, Anglo's investing more into copper now. And copper is used not just in some of your new technologies. It is still used in your old world infrastructure.
Sure.
Build. So I think yes, there might be a bit of a shift towards newer technologies, but that doesn't mean your old industrial base metals won't be in demand going forward.
Yeah, and just very briefly, before we do take a look at some of the stocks that we'll evaluate in just a moment, I want to get your view on how we've actually seen the size of mining companies change and their focus of their portfolios also alter, given the most recent crisis we saw back in 2014, I think it was, Viv. Your take on this? We usually think diversified miners are these huge players, but actually becoming
like BHP
a lot more smaller.
And South32. Yeah, look, I mean, also you got to understand with these mining companies, and I think there's another factor we've got to put into play here, is that the countries, or the source countries, where the resources are based, are becoming a bit cleverer. So you're not going to see the kind of super profits you saw in the past, because companies or countries that are out there are putting into place these super profit taxes. I've seen that happening a lot in Africa. I've seen that happening in South America. There was this case, I think it was Bolivia, Ecuador, one of those countries, I remember, where there was a pipeline that they built through the country, and normally it was an 80-20 split, 80 for the company, 20 for the country, and then the president came into power, he just flipped it around, it says 20 for the company, 80 for the country.
Whoa, that's a big jump.
And we've seen massive fines being put through to some of these companies up in the middle of Africa and so on. Even South Africa, of course, we've had the situation with regards to the changing mining charge charter and so on. You've got to understand when it comes to the geopolitical situation, some of the profits we saw in the past, even the demand for prices are quite high, goods are quite high, the price of the commodity is quite high, that the super profit situation we saw back in the past where we'd see these companies make these massive profits if commodity prices went sky high may not be the scenario that we can see going forward, especially as countries, the trend is to actually impose some kind of caps almost on profits by saying if you go beyond a certain point of profitability, we're going to start giving you this ratcheting up taxation coming through.
I suppose if you come back, to 2014, 2015, and you think of the mining companies then, what they look like then and what they look like today, there's this lag, I suppose, in demand and supply when it comes to commodities. So, when times are good and demand's high, what mining companies tend to do, and this comes to allocation and I suppose management's capital allocation and management's decisions at the time, they tend to react after the fact, and then they bring on supply by going out, making acquisitions, investing in capex at exactly the wrong time, right at the top of the cycle. And that's what we saw, going into the global financial crisis, late 2000s. And what happened was, when commodity prices came off, as we saw, suddenly these companies' balance sheets became extremely stressed. And I think now we've started to, over the last few years, we've seen them clean up that act. From a capital allocation point of view, I think they're doing a far better job today. And we've seen their debt piles coming down materially, as well as capital being returned to shareholders. So I think they're doing a far better job today than what they were probably 10 years ago.
Well, it looks like they look a lot more fitter and in shape at the moment. But of course, hopefully the prospects in the future remain the same too. But do stay with us. We're going to take a brief ad break. But before you actually go, do be sure to keep your emails coming to portfoliowatch@abn360.com and continue to interact with us on social media. Tweet us at CNBC Africa using the hashtag PortfolioWatch. We'll be back to talk more stocks to include in your equity portfolio when it comes to mining companies with commodity exposure. Welcome back to Portfolio Watch, where we're taking a look at the influence of commodity price cycles on the markets and, of course, the impact that it has on resource-based investment choices you make. In studio, I'm joined by Andrew Dittberner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Govender, Portfolio Manager for Swiss Offshore. Now, gentlemen, we certainly set the scene just before the ad break, really trying to evaluate what's been going on within the commodities sector when it comes to exposure. But we need to talk stock-specific stuff. And what's intriguing me, firstly, before we actually jump into any stocks, is that you haven't necessarily chosen any gold counters or platinum counters. So it seems as though single commodity players aren't necessarily the flavor of the month here, Andrew.
Yeah, I wouldn't say they're not the flavor of the month. I guess, when you think of gold, I think gold does have a place in a portfolio, but from a pure commodity point of view. It's an alternative to money if you think about it. So it's a nice diversifier. If there's a monetary crisis, gold would act as a downside protection asset class there. But to get your single stock exposure through a mining company, I think is when you look what's going on in South African mining specifically.
Yes.
The input costs have been under a huge amount of pressure. These gold mines are not new mines. They're very, very old. They're very deep. So there's a lot of risks. And to try and, given that gold doesn't really have there's no real use for it, industrial use for it. It's very, very difficult to try and assess what the gold price is going to do. Then you've got the US dollar that you're thrown on top of it. It just makes, I think there's a lot of risks that come into play. Yeah. Platinum probably less so because there's an industrial use for it through your catalytic converters.
So let's talk about some of those diversified players, many of whom have actually seen a split in some of their assets. And so let's start with BHP Billiton, one of those that's your choice. And South 32 is actually one that you're quite keen on here, Viv.
Yeah, so BHP Billiton, it's actually BHP. I think they're dropping the Billiton on there. Yeah. So BHP, if you're looking at global diversified mining companies, I don't think you get a better quality company than what you'll find in BHP Billiton. And when I talk about quality, I'm talking about the quality of their portfolio, the mines that they own. And if you look where Billiton was, you go back to that time that we spoke about earlier, 2014, 2015, they didn't take nearly as much pain as some of the other global diversifieds, being your Glencores, your Anglo-Americans, etc. And that's purely because of, you know, the strength of their balance sheets, which has come through. We see even today, you know, back then they had 26 billion net debt on their balance sheet. Today I think it's about 11 billion. That turned out 12.5 billion free cash flow in the last financial year. And the year before they did 12 billion. So if you take that, you know, it's not going to be too long and they'll be net cash positive. So, you know, I think it's a really great business if you're looking for a global diversified miner. Doesn't have exposure to South Africa. As you know, it's sold off, I think, about 3 years ago. Their South African operations, which has now become known as South 32.
Known now as South 32, and of course trying to remain resilient despite how volatile the local market has been. Is this one that you keep in your portfolio, though?
Just a word of caution here, he chose first. So I was left with the scraps that out. So, yeah, look, I mean, when it comes to generally comes to this kind of thing, my thesis in here is that, like you said, the single commodity miners or producers, I'm not really keen on. I think in the environment we're seeing right now, sometimes you have surprising moves, like for instance, coal versus base metals. Coal's done really well versus base metals. That separation's been there for a little while, and it's really it doesn't usually get this far apart in terms of the spread. And what I'm saying is basically in an environment where you're uncertain about the commodity pricing, you want to be basically investing in a diversified commodity producer, because they have more expertise into what to put their brain power into and what to put their production into, and you have the ability, you know, in that scenario to actually, you know, benefit from, you know, some of that stuff. Like, you know, like you see, a number of our picks are going to be diversified producers with just one or two, you know, single commodity, you know, producers out there. So yes, that's my reason for going with that. I want to have a portfolio in which I rely to a certain extent on the diversified producers as actually going out there and actually giving us a bit of their, you know, alpha in terms of picking the right commodities to focus on.
Sure.
Yeah.
With that said, though, I do know that Kumba also features on your list, coupled with Anglo-American, because Kumba does fall under Anglo-American. And interesting contrast between those companies. Remember, there were rumors that Anglo was meant to sell Kumba a few years back, and that never came to fruition because they managed again to sort out their books and get their numbers right effectively. But what's your take on Kumba and Anglo-American, and perhaps if there's an investment case here for us to consider?
Yeah, look, I would go for Kumba. And, you know, actually they're both my picks here. So, so the reason I go for Kumba is the fact that I know has been, like I said, a strange case in which we are seeing, where we predicted a couple of years ago that there'd been oversupply in the market. That has not really happened because of the changing, you know, requirements for the grade of iron ore coming out of China. A report just came out of the Australian government just a couple of weeks ago saying how they expect this massive drop-off in pricing in terms of iron ore prices over the next year or two. But at the same time, we've seen, you know, more predictions from the mining companies themselves, like BHP and so on, coming out and saying that they don't expect that pullback to come until the middle of the next decade. So we're talking 2023, 24, 25. So we're talking a few more years of this demand coming through for you know, iron ore from China. And China is the key sector here, as they are in most commodities. I mean, we don't realize, or most people don't realize, just how much of the world's commodities are actually demanded by China. In some cases, it's 50%, 40% of total, you know, demand for some of these commodities. Seaborne demand for, you know, iron ore is like 50+% from China alone. So it's really the driver of the commodity market. So Kumba, I think, is a special case in terms of that. I can see that market here having some legs to stand on, at least for the next few years, especially if you consider just how the predictions coming through from of course, they have a certain extent a bias to you because they are the mining companies. But historically, I think for the last couple of years, the government has gotten it wrong and the mining companies have got it right. So I'm still trusting the mining companies in their forecast that we still got a couple more years, probably till the middle of, say, Alex, the 2020s, before we start seeing China pulling back significantly on steel production.
Well, let's hope so, because those forecasts work in their favor, right? Regarding market expectations and earnings outlooks. But what about ASO? That's also another one that often doesn't necessarily feature top of mind for the retail investor, but also has quite a base for us to consider. Yeah,
probably not top of mind because it's fairly tightly held. I think it's only about a 20% free float in ASO, so it's not widely covered by your research brokers or research houses. So there's not a lot of news, you know, around ASO. ASO, it owns a asset for 50% of an asset called Assmang. African Rainbow Minerals owns the other 50%. They mine iron, manganese, and chrome. And it's been around for a very, very long time. And Viv touched on, you know, the need for high quality iron ore, and I think these guys probably produce the highest quality iron ore. So there's huge demand coming from China in an effort to clean up the environment, etc. So looking back over time, looking at dividends, I'll challenge you to find a company that has been able to, a mining company that has been able to pay dividends. I've looked back 30 years and they've literally increased dividends every single year for nearly 30 years.
Wow.
Probably, a handful of times that they didn't actually increase, but they've paid dividends every single year, including going through the global financial crisis. So it's that just gives you an indication of the quality of this business being, operating in this hugely cyclical industry, yet being able to generate that free cash flow given the high quality of the assets.
Something for us to certainly consider, despite some of the pressures on that company. But so often we always think about the mining companies digging into the ground, getting the resource out the ground and bringing up to the surface. But we never think about the equipment that's required in that particular space, right? And I'm assuming this is where master drilling obviously comes in as a particular stock. Is it one that you hold, Viv? You can also jump in and give us your views on this one.
No, so we don't actually hold master drilling just purely because of the size. I just think it's a really interesting little company, proudly South African business. They essentially sell holes in the ground. It's raised bore drilling is what they do, based out in Mfuphi. It's their own intellectual property. I've actually been out to their operations there, and it's a fascinating, business. When you look at it, they can sit in Mfuphi, which is near Potchefstroom. Probably not too many people know where Mfuphi is. And they can control their rigs that are sitting in South America, North America, anywhere in the world, from their base in Mfuphi.
Sure.
So it's a company that counts all of the global diversified miners as their clients. They sell their machines. I think they the only company in the world that can drill some of these holes. They're now looking at horizontal raised bore drilling, so they can drill not just tunnels going down, but tunnels that you can mine in underground, using their machinery. That's as I said, it's their own intellectual property. It's a fascinating little business, and it's another way of getting exposure to the resource sector or to mining companies without actually going and buying direct mining exposure. Who
knew that we had all that innovation just right outside of Potchefstroom, of all places in South Africa? Is this one that you keep or monitor from an assessment point of view?
Like it also said, it's a bit too small for most of our portfolios. That being said, another trend that we have to talk about in terms of the mining sector is the shift towards environmental safety, as well as worker safety as well. It's not just local, it's international. We've seen this huge, of course, the BHP disaster in South America. We've seen a number of these cases around the world where we've had obviously the issues. Even I think the commodity sector, Monsanto just had this massive fine for a lawsuit that they lost for Roundup. And this is something that we're going to see going forward. The same, the expertise, the high-level producers of equipment, the high-level miners out there in terms of technology and so on, are going to be the guys that succeed in the market. In the past, you can be, in some place in the world, you can be cheap and dirty, but I don't think that's a viable strategy anymore. You have to be high-tech and clean at the moment to make it in this world. And I think something like master drilling will actually be benefiting from this kind of shift in global trends.
Exactly. Makes sense, and at least there's some good news coming out of the South African mining fraternity. As we know, we've been bogged down with quite a lot of pressure, whether it's mining or operations that also take place. Another proudly South African company within the resource space is Sasol. Is this one that you like, Govender? What's your thesis on this investment case here?
Well, at the moment, the oil price, looking at the way it is, and the rand looking at the way it is,
we're loving it.
I have a client that has quite a bit of it, and he's smiling at the moment here. Look, it's a case with regards to the oil price at the moment. I think in the short term, probably oil prices have a bit of leeway. They can go to 100 and so on. But here, I think the technology works against the market because of the fracking technology and so on that's happened around the world. We have a lot more accessible oil when we get to a certain level in terms of oil prices. And one of the things that we've seen over the last couple of years is that, even though it hasn't happened this time around, is that the production in the US actually has been like a kind of a barrier in terms of oil prices rising above a certain level. The production in the US tends to rise quite significantly and quite quickly whenever oil prices rise significantly. Right now it hasn't happened, they haven't reacted quickly enough. But I do think in the longer term, the technology is going to trump the demand side on this particular environment.
And should we also be worried about the geographical exposure that they have here, right? They experienced some pressures in Mozambique, saw some ongoing opportunities in the US, which have also come under pressure here. Louisiana, right?
That's it, Lake Charles.
Yes.
So I think Sasol, if you look back over the history, they've got a pretty poor record of, bringing these big projects, online, in time, under budget. And Lake Charles is a great example of that. This is a project it's an ethane cracker that sits there. Yes. And it's been going on, you know, the build of this has been going on for many years. It's run over time, it's run over budget by a long way, and now it's expected to come, I think, online beginning of next year. But I think that still presents a massive risk. It's a huge project for them. It's it's over $11 billion, worth of capex. That's a massive amount to spend on a single project. And when you look at the valuation, I don't think the market's really giving much value to that project at the moment. If you just look historically, Sasol obviously very closely follows the oil price and then the rand-dollar exchange rate.
Sure.
And if you look at that historically, where it sits today, it would imply that the market's not really putting a huge amount of value on Lake Charles. So either they're pricing in that oil price is going to be coming down, or the rand's going to appreciate, or Lake Charles is not worth a hell of a lot, or some combination of those three things. But there's too many, we don't own Sasol at PCS. There's too many unknowns here. There's the macro variables at play that are completely out of their control, are far too many. So you've got very little visibility. And we've just seen it, beginning of this year, everyone said oil can't go above $60. It hits 60, then the US frackers come online, and then supply, keeps it below that $60. Now we're at 80, and everyone's saying, well, it's going to 100.
Precisely, right?
The price elasticity between, demand and supply is very, very high for oil. No one knows where it's going.
Exactly. And I guess that's something for us as investors to consider, is that ultimately that elasticity is exactly just that. Could go in either direction at any time. So be careful as to how you try to assess the market, right, regarding commodity prices.
That's it.
On point. See, so I'm learning something too here on the show, no doubt. Gentlemen, thank you so much for your time. It's been great hearing a lot more about the assessment of how best to analyze your exposure to the commodities as well as resource space from an investment point of view. A big thank you to both my guests, Andrew Dittberner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Viv Govender, Portfolio Manager for Swiss Offshore. And of course, thank you for tuning in. But do keep your questions and suggestions coming in. And of course, you can tweet us at CNBC Africa using the hashtag PortfolioWatch, or email them to portfoliowatch@abn360.com. Until next week at the same time, have yourself a wonderful evening.